My guest this week, Karey Rivers III, a financial services specialist. Let's hear what he had to say. Good evening and welcome to Stewart Spotlight Podcast. My name is William Stewart Jr. and I am your host for this evening. I hope everyone had a wonderful weekend and getting ready for this exciting show that we have planned for you this evening. Got some feedback. As I said before, I hope everyone had a nice weekend. Nice week. Just want to recap some of the things that happened this week. I hope you were able to watch the debate between Vice President Kamala Harris and Donald Trump. It was very, very, very interesting. And people should take note of that. I got a little soundtrack that when Vice President Kamala Harris was getting upset with Donald Trump, and she paused. She had to get her thinking together. So take a look at this right quick.
What's your favorite curse word?
I can't say it. It starts with an M and it ends with
This former president
So I'm sorry. So everybody know what that word was or was going to be, but I guess she realized there are 70 million people are watching, so she had to rethink and recoup some of her thoughts behind this. But that was very interesting. And I had, they put everything on TikTok, so I had to play that little skit right quick. Also, today is Friday, September the 13th, better known as Friday the 13th. I don't know what that means, but people have different. Oh, I got a lot of feedback. A lot of superstitious about Friday the 13th, but it doesn't bother me not one bit. So it is what it is. And also, Wednesday was September the 11th, better known as 9/11, where there were several terrorist attack on the United States soil. There was 4 hijacks of planes that killed nearly 3,000 people, and 2,753 people was in the Trade Center that died, and 184 killed in the Pentagon, and 40.
What's your favorite curse word?
40 people.
I can't say it.
40 people were killed.
And it ends with
This
I'm sorry, I had to look at it again right quick. So 40 people were killed on the board of an airplane, and I put together another little soundtrack just in remembrance of the people who lost their life. Take a look. That was just a little soundtrack paying tribute to those family members who lost their loved ones during the 9/11. But everyone knows it is time for that special moment that I'm always asking for you to like, subscribe, share, and make sure you turn on your notification bell. So therefore, every time we are live, you will get a notification on your phone to let you know we are live. Tell a friend, tell a neighbor, tell your relatives. Make sure to tune into Stewart Spotlight Podcast. As I stated before, we have a very interesting show today, and I'm not going to prolong it. I'm going to go into a little small break, and then we're going to come back, and we want to speak with my guests. So after this break, stay tuned. Hello, my name is William Stewart Jr., President and CEO of Stewart Spotlight. The purpose of this podcast is to showcase individuals like yourself. We all have something to share about our lives. Therefore, I challenge you today. If you went through something, coming out of something, and just want to share your testimony, we would love to hear your story. So please give us a call at 888-552-1944. And one of our producers can make arrangements so you can appear on this podcast. Or visit our website, stewartspotlight.com. Because of your experience, it can reach someone who is watching this podcast and make a difference in their lives. Yes, it could make a difference. As I stated before, my name is William Stewart, and welcome back to Stewart Spotlight Podcast. Today's guest is Mr. Karey Rivers III, an entrepreneur specialist in financial services. We're going to talk about life insurance, 401k, and retirement plans and mortgage protection plans, the whole 9 yards. He's well, I'm just going to bring him on. How about that? Without further ado, let's welcome Mr. Karey Rivers III. Welcome to the show.
Stewart.
So I'm so glad that you had took the time out of your busy schedule to come on the show to share your experience as an entrepreneur. So for the audience, I just want to give them a little history about yourself. Do you mind if I call you Karey?
I don't mind at all.
Okay.
Thank you.
Karey is the middle child of 6, 4 boys and 2 girls. One brother has passed away. Attended Middle Georgia State University, Clayton State University, and Liberty University. Karey has a passion for music. He's been playing the guitar for over 30 years. Wow. Wow.
Yep.
And 6.5 years ago, Karey launched his own brokerage company. So we're going to talk about, as I said before, mortgage protection, life insurance, 401, and retirement. So are you ready to talk about this?
Yeah, I'm as ready as I'm going to be, man.
All right.
This is good.
Okay, I'm glad. So let's talk about let's go with the mortgage protection plan. So
Sure.
What exactly is a mortgage protection plan?
Okay, I'm glad you asked. And again, Stewart Spotlight, William, I really appreciate the opportunity to be on your show. I love your graphics.
Thank you.
And also, I was laughing a little bit at that clip about Kamala Harris. That was actually pretty funny. Well, a mortgage protection plan, just kind of imagine a person who owns a home, a family, and say that husband came in from work feeling a bit clammish and not feeling good and wanted to go to the doctor and get a checkup. Comes to find out that he has a rare blood cancer after the checkup, right? And so in the event of something happening such as that, where do you get the funds from? Where do you get the money from? Do you dig into your retirement that you have created or your savings? What do you do? So that's where a mortgage protection plan comes in place. A mortgage protection plan is a life insurance with a living benefit attached. So basically, go ahead.
So does it covers the mortgage, correct?
Well, no, not necessarily.
Oh, okay.
The actual benefit of this, it covers whatever you see fit to use the monies for.
Okay.
Basically, if you have enough life insurance to cover the mortgage, that's great. But if you want to utilize whatever funds available and been allotted through the insurance company, you can use it to pay bills off. You can use it to take care of your car. You can use it to pay your house off or for the mortgage, or, any type of treatments that health insurance might not cover. For instance, there was a client who had a heart attack and was able to access $80,000 of his life insurance policy while he was alive to pay off the rest of the balance of his home. There was another client, she had leukemia, was able to extract portions of her life benefit to take care of other duties around her home. So it's used based on the benefit that you need it for. And believe it or not, there's no penalty in using it.
So basically, you can design the mortgage protection plan according to how you want it, such as if you want a critical illness or anything with dealing with health.
But basically, the living benefit that comes along with the plans that I have, it is tailored around 3 to 4 major situations: critical illness, chronic illness, critical injury, or terminal illness.
Okay.
And so, so basically, there are certain triggers within those fortes that will happen. Like, just give you an example: heart attack, cancer, stroke, ALS, cystic fibrosis, Lou Garrison. That's for critical illnesses. Sudden cardiac arrest. Then you have. And there's a few more. Then you have the chronic illness. Chronic illness is if a person cannot do 2 out of their 6 everyday routines. If a person can't go from one room to the next on their own, or at the end of the day, their countenance, they can't hold their countenance in their body. Also, if they can't get to, toileting is another issue, of bathing. So 2 out of your 6 daily routines, if you can't do, that's labeled as a chronic illness. So basically at that point, what happens is the doctor signs off on that. And then once that physician has checked off those balances, an individual can actually make that claim in. But with a chronic illness, it has to be at least 90 days.
So now is this expensive?
No, relatively, home mortgage protection is not expensive, but at the end of the day, it does depend on the client. Depends on your age, health insurance. Now, I mean, life insurance, the insurance itself is based on the customer. Always really remember that your health is your credit here when you're dealing with insurances.
Okay.
And also age plays a part in that as well.
Okay, so I was just about to ask about, now suppose if you was cancer based, would you be rejected by applying for this particular?
It just really depends. If you have cancer or a pre-existing condition like that, it'll be kind of hard to get covered for, anything, because you have to understand, when you're dealing with insurances, they're dealing with the liability of it all. The insurance company is carrying the risk.
Okay.
So you understand, when you have a condition like cancer, sometimes it's kind of hard to get something in that moment. But post-cancer, depending on how long you've been, free from it, how long you've been healed from it, you can still get qualified for some insurances to have that type of protection.
So now, if you were to sign up for a program of this nature, and how long do you have to continue to pay for it? Or does it come to a term that you don't have to pay no more and it just continue to be there for you? Or is it just a continuous premium payment?
Well, a mortgage protection plan is a plan that actually is continued based on how long you have your mortgage. But at the same time, it does convert into something a bit more permanent for you if you would like it to be. One of the biggest things too with the mortgage protection plan, it travels wherever you go. So if you refinance your home, you don't have to start over. Or if you position yourself to move in another state, it goes wherever you go. So you don't have to, you could sell your home 5 times, but don't have to start over again. So it's basically goes wherever you go.
Is this this plan, is it tax free, or you have to pay taxes on it if you were to become ill, and the funds that you get from the plan, do you have to pay taxes on that as well?
No, it's tax free.
It's tax free.
Yeah.
Okay. Okay. So tell me a little bit more about the mortgage protection plan.
Well, the biggest thing is just understanding that the living benefits is what I really, really push for a lot of homeowners. One of the biggest investments for individuals nowadays, outside of getting married and buying a car, is getting a home. And that's one of the major things that I push with my clients when I'm talking to these type of leads and people with homes is what happens if you get sick or hurt? What happens to your home? What happens to your family's life? Would you have to move in with your in-laws? Do your in-laws know you have to move with them? How long would it be before your car is repossessed, or what does bad look like? So these are one of these plans that I really feel is definitely needed for a home owner, and thinking about those things. And sometimes people don't think about it because you don't want to talk about using it. Of course, no one wants to use the insurance, but at the end of the day, it's best to have it and don't need it than to need it and don't have it.
Now, once you have a buildup, could you borrow off of your off of your mortgage insurance?
Well, this particular plan, though,
No.
you can't, it doesn't build cash value on this particular plan.
Okay. Okay. So basically, so what's the difference between that plan and the PMI?
PMI.
It's the principal insurance mortgage or something of that nature.
Well, now you may get like a insurance that comes along with your mortgage when you purchase your mortgage. Now, that particular insurance has nothing to do with you as the client or customer. That's more or less protecting the liability of the bank if something happens to that home.
Okay.
And so it doesn't cover you. It doesn't cover you per se. It covers the investment of the home that the bank owns until you pay it off.
Okay. Now there are several brokers out there. So what makes your company so distinct from the others?
Well, for me personally, and this is a non-biased conversation from myself, is because I put the customer first. It's not about a commission for me. It's about making sure what's best for the client. It's make sure what's best for them. I'm here to build relationships. I run a commission-based and referral-based business. So if I don't take care of you as my client, I don't have any type of referrals that could come from you to me. I, will shoot myself in the foot of not really taking care and properly handling my client. There are a lot of people out there that push for certain plans without really getting to know who you are. They push for certain plans just to make sure they get a good commission check that pocket their money, but, kind of solidify you in something that it's not even beneficial for you and your family. So for me, I'm very distinctive on my customer service. We are very distinctive on our customer service. Before I got into this, as you know, I'm a musician, but I spent almost 17 years in the customer service realm as well. So customer service, loving people, making sure people are good is the number one thing for me.
Okay. So let's talk about life insurance.
Okay. Absolutely.
There are several different types of life insurance policies, such as the whole life, term life, universal life. What's the difference? Because I know the whole life builds up value, cash value, versus the term life. And what's the difference between those two and a universal life?
Okay, so a term, as you know, term is just kind of think of a term policy like a lease or like a lease an apartment. Like you got 12 months and after the 12 months, then you either got to renew or you find somewhere else to go.
Okay.
So with a term life, it's pretty much the same concept. So you can break them down into 10, 20, or 30 years. And so basically, they don't build cash value. They're usually a little cheaper because you don't build any cash value and you're paying for the actualized insurance. And at the end of the day, too, once that term is up, then the insurance is, gone, or then you renew into something else based on your age at that time. So that's what a term is. Now, whole life is a little bit more expensive. Reason is because you're not only paying for actualized insurance, but you're paying for a predictable interest rate on that insurance, and you're paying a cash value build for the rest of your life. And so interest rates on a whole life is generally between, depending on the company, between as low as 1% up to about 4.5%. And you can borrow against those. It takes a little bit more longer to build cash value on whole life because of the actual 4.5 or 1 to 4.5%. And those are not as flexible at all. So they're pretty much predictable on what you're going to pay every month and also what you're going to get coming 2 years to come.
Okay, so now what about the universal?
Universal is a little bit more flexible. It is a permanent policy, but it's a little bit more flexible based on the fact that it does have some safe investments on the back end to where that you can actually have growing interest. So you can get something a little bit higher than a 4.5% interest rate. And also at the same time, it gives you faster cash value on the back end. So the difference between that and a whole life is a bit more flexible and a little bit less predictable on what you can actually gain on the back end.
So now how do I determine how much insurance I'm going to need?
Generally, you determine, it's a great question. You generally determine on how much insurance you would need based on your income. Generally, you would want to do between 3 to 5 times your annual income.
So therefore, you're telling me if I made $10,000 a year, I should have the insurance about $50,000.
Yeah, about 50 to 60. But, generally, if you're an adult here in Atlanta, Georgia, it's going to definitely be a little bit more than that. So if you're looking at maybe, let's just say easy math, $100,000, and you're pretty good in taking care of all of your expenses, I would say I would gauge that between you should have at least $350,000 up to maybe $500,000 for insurances to cover. You kind of have to think about that. So if you look at the fact that someone passes away, you got not only maybe say if you got the mortgage due, you not only either going to pay the mortgage off or you're going to pay half of the mortgage off. Think about expenses and things that you have to take care of after that person has gone away. Then think about the fact that the surviving member, maybe the wife and children, how are they going to live? What are they? You have to determine those type of things. So I'm gonna try to see if I can do some easy math for you real quick.
Yeah, because that sounds very expensive, $500,000 for insurance. And it really depends on your age as well, too, because if you're between the 40 and 60 range, that could be really expensive on a month-to-month basis.
It could be, but that's the purpose of having the education, though, William, is the fact that a lot of people wait until later to get insurance. And that's where the issue comes in at. You should not wait until you're 50 years old to get insurance. A lot of times we haven't been educated on the fact that, it's cheaper and more affordable when you're younger because you have less health issues. And when you're younger, the price is more lenient on you because you are getting started. You're young, you have less liability, and then you're not sickly. But by the time you get of age, you become more subjected to heart attacks, cancer, strokes. Now you become more of a liability on the insurance company. And so then, so if we're going to actually be footing the bill in the event of something happened to you and we have to spend money out, then, of course, you got to take a look at where you are currently in life.
But once again, for $500,000 of insurance, that could be. Give me an example. How much would $500,000 insurance for a person between 40 to 45?
That's going to be conditional based on what we're choosing. And what company you're using. So I would actually have to be in a place where I'm creating a quote for that person.
Okay.
So that's why for me, it comes into me having a conversation with you. It's going to be conditional on what type of medications, if you're on medications right now.
Okay.
So basically in those type of issues, in those type of scenarios, I do what you do, a pre-screening with my clients. So I send things into the underwriters so they can actually let me know how to rate you. Then I can give you a pricing on that.
Okay.
So just to actually give a quote or average quote, I really don't do quotes as a specialist. I ask a lot of questions, and I put in for the cost.
I was just throwing that out there, see if
Yeah,
you was
I know.
going to take the bait or not. But I do have another question because,
Sure.
so now you mentioned it would be better if you buy life insurance when you're younger. But what, I purchased a $500,000 worth of insurance today.
Okay.
I die tomorrow. Would that same $500,000 be covered, or do you have to be in the insurance for X amount of years for that build up?
No, I mean, if you, the thing about that is a lot of people try to fill out an application and they try to wait to extract the funds maybe a week or two later. But basically, the important thing is to, now that you have electronic applications, not paper applications, the best thing is if you fill out the app and we submit the app and you have this app ready to extract the funds for a guaranteed issue, well, to extract the funds once you've been approved. Once that goes in and and premium goes in, it's set to go and you pass away, then you're still subject to get what you applied for. Obviously there is a significant, they may do some sort of investigation to make sure there was no predetermined nothing before that happened. But, things happen. People, can just all of a sudden pass away. You know what I'm saying?
I like that term. You say subject to.
Yeah.
So that's not a promise. That's a subject to.
Right.
Okay.
Right. It's subject to, but you have to. It's just, going into those gray areas. You just have to understand that before an insurance company pay out $500,000, they have to do their due diligence too on the back end.
Now, suppose if a person miss a payment. Is it canceled immediately, or do they give you a leeway?
No, it's not canceled immediately. You do have a grace period, but it's definitely important to know that if you're going to start any type of insurance, just to always keep track of payments.
Okay.
They do have automatic draft, and generally automatic drafts occur on the date you choose, maybe a day before, generally a day before, maybe a day after. So anytime between those 3 days, day before, day of, or day after, is when they will probably extract the payment.
So now, the insurance we're talking about is whole life, I'm assuming.
It's all insurance, like far as payments is concerned. Now, what do you mean as far as whole life?
With the build up of the cash, in case a person say, well, I need to borrow some money I want to pull money from the insurance and pay it back. Is that possible?
Absolutely, it is. If you have the money there to borrow against the policy, you can always create a loan for yourself and you pay it back. The thing is, a lot of people don't understand is if you don't pay the loan back and you pass away, what you borrowed come from the death benefit.
So, but is that the same as in term and whole, or is it just a whole?
Just any cash value building product.
Because I didn't know you can borrow from term insurance.
You can't borrow from term, but if you have a living benefit life insurance and it's a term, you can actually utilize that death benefit.
Okay.
But it doesn't grow cash value, but you can borrow, you can extract a living benefit trigger from that.
Okay, gotcha. Karey, can you hold on for a moment? Let's take a little break.
Absolutely.
And we'll be right back with Karey Rivers III. Hold on. And we are back with Stewart Spotlight live with Karey Rivers III. Karey, we spoke about mortgage protection. We spoke a little bit about life insurance, whole life, term life, and universal life. And let's talk about 401 and 401k and retirement plans.
Cool. Okay.
these days,
Mm-hmm.
a lot of companies don't offer pension plans.
Right.
They're offering the 401k. So basically, it's up to your it's your responsibility to manage, because a lot of companies don't really contribute as they used to in the 401k. So now, how does that work? Because if you opt to create or opt to buy a 401k,
Mm-hmm.
how does it build up? Other than you continue putting money in it.
Well, I mean, 401ks, just kind of go back to the history. 401k was created back in between 1979 and 1981. I think Mr. Benner of the Johnson companies was kind of put himself in a position to whether he wanted to. He's a benefit specialist. I think he was out of Philadelphia, out of Pennsylvania. He wanted to look at another tax bracket of helping people create a tax-free method for building retirement. So basically, how does that build up? It is utilized as a market-based product. So, it's utilized by mutual funds, stocks, and bonds. And so what happens is a lot of companies, they allow themselves to contribute a portion to match you from your income in the workspace. That's how that works.
So if the company is not making profit, so you get less. Or if you are you talking about the stock that they invest your money into, or the stock that you invest your money into, and hoping that the stock market would go up or go down?
Yeah, basically to a degree. Now, the company itself utilized their fiduciaries like some of the bigger companies like Schwab or Fidelity. Those are the people that actually look over those accounts for the company itself. And so the companies position themselves to have some sort of matching operation to help create that profit for long-term gains for the employee.
Okay.
So that's how that works. And so the company itself chooses how much they would be willing to match for the employee that actually wants to participate in that.
So is there a maximum that you can contribute into the plan per year?
If you're working with a company, it'll be based on them, and sometimes they don't, you may can put in a little bit more, but companies always, they have their limits and their caps on what they're going to do.
So, okay. Now,
Yeah, you can probably, as an employee, you can put as much as you want. If you want to put in 10% of your check or you want to put in half, that's up to you.
I thought there was a cap with the internal revenue that you only can put so much into per year.
In some of them, it just really depends. Now, with an IRA, you do have a cap like up to $6,000 annually. When you get older, closer to retirement, it'll be a little bit more. Sometimes they kind of give you leeway up to $7,500, but there is a cap with forms of retirement like your IRAs.
Okay.
Every year.
So the 401k doesn't have nothing to do with the IRA.
No.
Okay.
Yeah,
So now you put money away.
Mm-hmm.
You put $10,000 away per year.
Mm-hmm.
And I'm surely it's invested in different stocks or mutual bonds or things of that nature. So you're looking at it to make sure that you're growing money. And you find that one of the mutual funds or bonds is losing money. Do you have the option to transfer it over to something else, or do you have to keep it in within a year?
Well, as far as when you're dealing with 401ks and those things of that nature, you can choose based on how you want that to be maneuvered, and you can talk to the fiduciaries that actually watches over that. That would be up to you. But for myself personally, I don't construct the 401ks. My position in my area of expertise is protection growth. And so I myself make sure that you never lose money. Those 401ks is a situation where that you will connect and talk with a fiduciary that has a series 6 and 7.
So now, therefore, a person can just come to you and say, well, I want to have a 401k. And you would do the necessary paperwork and sit down with them and advise them and lead them to the right direction. Am I to assume that?
Definitely will do that. Absolutely. People have to understand too, when you're dealing with 401ks, that you can invest in those. You can utilize them as retirement plans. But at the end of the day, kind of remember and understand it is driven by the market. So you can put money in and realize that if the market is doing well, you can actually have, great returns. But if the market is doing bad, your money can actually take a huge dent in whatever you have. And it takes over 100% to try to get back what you actually lost. So that's the way. That's how it goes with the 401k. And then realize too that once you invest in these, you cannot pull them out before 59 and a half without suffering a penalty of 10%. And then even when you pull it out, not only do you suffer that 10% penalty, but you also have to pay taxes on what you pull out.
So now,
it's almost like an income tax.
So if you're over 59 and a half years of age, you don't have to be. You're not being penalized for taking it out at an early, but you would be penalized for the internal revenue for the taxes.
Correct. 59 and a half, you're eligible to move it, but realize that you will have to pay that 10% tax at the end of the year or whenever you file your tax.
Okay.
Yes.
Okay.
But it's treated as an income-based removal. That's what a 401k is. It's treated as income-based. Yeah.
All right. So anything else you want to share with this 401 and retirement?
Well, what I would like to say that if you're looking to start a retirement plan, 401ks are cool vehicles if you're working for a company. I would never tell a person not to utilize their 401k when you're working for a company. That's free money that they're matching. You can utilize it when you're working. But one thing I would say, if you are no longer with that company, do not allow that old company to be a custodian of your money. Don't just let that money sit there, because number one, it's not gaining anything because they're no longer contributing to that vehicle, number one. Number two, you're not contributing to it, and it's actually sitting in limbo at the mercy of what happens in the market. My recommendation, if you do have an old 401k out there just sitting, give me a call, because I have products and we have vehicles that you can roll that over into to where that you don't have to worry about any type of market losses.
Wow, that's interesting. But viewers, you heard it here first. Mr. Rivers, appreciate you coming on and sharing some of the wisdom of the life insurance and 401k, retirement, and mortgage protection plans. I appreciate that. Any advice you would like to share or leave with the viewers who's watching as we speak today?
Awesome. Yeah, I would. Real quick, I know when we was early in our conversation, I was going to do some simple math for you.
Yes.
Concerning insurance and having the appropriate amount.
Yes.
Say if you have a person that makes $75,000 a year, and if they made $75,000 a year, and that's in 30 years, that is $2.2 million. That's $2,250,000. Say if that person that was making that money died in 15 years. So think about that. If they died within a 15-year time span, the surviving family is missing out on almost $1.1 million. That's why it's important to have at least 3 to 5% of what you have, 3 to 5 times more of insurance for your income, because if something happens to you in your working years and your surviving family is still here, they're missing out on over $1 million of what they could have had if you died or if you stayed.
So let me make sure I got this correct. How long of a period did you have to let that sit before it accumulate to that kind of money?
No, that's me letting you know how much insurance that you should have,
but
in congruence of having that type of income.
Okay, all right.
Yeah.
Okay.
So, because typically a person works 30 years, then they retire. If you multiply $75,000 a year times 30, you get $2.2 million roughly. And if a person dies within 15 years of retiring in 30 years, that family is missing out on $1.1 million.
Okay.
And
gotcha.
so if if you position yourself to have that much insurance and you pass away, then that family is not missing what you could have made if you yet was alive.
That makes sense. That makes sense. Wow. Okay. Well, viewers, you heard it here. If you want to get in contact with Mr. Rivers, feel free. I just put on the screen what he handles, the mortgage protection plans, the 401, life insurance, and retirement. His phone number is listed below, and his email is there as well. Mr. Rivers, thank you for coming on.
Thank you.
And I really appreciate the education that you have provided to us. That there's a lot of stuff that I didn't know about, but I don't know everything. So that's why we have people like you to come on to share your wisdom and knowledge to everyone else. But thank you very much, and feel free to come back anytime and to share more information.
Absolutely, thank you.
We have Mr. Rivers. Thank you, Mr. Rivers. All right. Well, Mr. Rivers just spoke, and we listen. So once again, I have already provided the information on the screen in case you wanted to get in contact with him. Feel free, and maybe help you out a little bit. Okay, let's talk about last week. We had a trivia question last week, and the trivia question was, what was the name of the radio personality known as the Fly Jock? And the correct answer is Tom Joyner. And we have a winner, Jesse Scott Thomas from Tuskegee, Alabama. Congratulations, and you will be receiving a t-shirt in the mail within 5 to 10 business days. Make sure you always continue to share, like, and subscribe, and tell your family and friends to look at us as well. So right now, it is time for the trivia question. Let's look.
Give the correct answer and you can be a winner of this Stewart Spotlight t-shirt, sponsored by William Stewart Jr.
It's time for Stewart Trivia. Let's put on those thinking caps. Which singer is known as the Queen of Pop? Is it A, or B, or C, or D? The first person who calls with the correct answer at 888-552-1944 will be the winner of the Stewart Spotlight t-shirt. Good luck. And you heard it there. So the first person who called us at the 888-552-1944 will receive a free t-shirt. Our guest at the end of the show, Lee Jones, is not here. I just seen the text. He's been sick all week, so we're gonna keep him lifted up in the prayers. However, next week we have a special guest coming on next week. Next week will be Clarice Anderson. She's an author, and the name of the book, Intelligence Isn't Enough. Once again, intelligence isn't enough. Thriving in the workplace. Can't wait to hear what she has to say. I made some notes in the book. I'm going to ask some questions about myself. But anyway, I hope everyone enjoyed the show. Feel free to give us a call. Or matter of fact, if you want to send us an email. Give us some thoughts and some feedback of what you think. And I'll be happy to share it with everyone else. So now it is that time of the day that we must end the show. I know I don't want to leave either, but we have to. So I want to thank you for tuning in and watching Stewart Spotlight Live. It's always a pleasure to share some interesting and knowledgeable wisdom to the viewers. Always remember, it's not about me. It's all about you. Until next week, have a nice weekend and be safe. Good night.